Hey everyone, Mike here with Financeable. Welcome back to our interview question review series. Today we're going to take a look at the Depreciation Tax Shield, which is a common interview question. We have a lot more interview questions coming soon. Please do subscribe and let's hop in. Alright, so to begin with, this looks like an accounting question, but it's actually deeply rooted in valuation, in particular, the impact of depreciation on the cash flows of the business which drive valuation. And we're going to work through an example here where we'll ultimately see how depreciation impacts the cash flows of our business. So quick note here, you'll notice that I have Depreciation Tax Shield at the top of the screen here, not D&A Tax Shield, and that's just how people usually describe it, but really this concept that we're exploring encompasses all non-cash charges. Virtually any non-cash charge is going to create the same tax shield impact. All right, let's take a look at this in motion. So we're going to look at two scenarios here where we see the impact of depreciation on cash flow. But we're going to start with working down to net operating profit after tax, which is our tax-adjusted EBIT, and it's also called NOPAT. That's what we've annotated down at the bottom. So let's work with these two scenarios, one in which we deduct D&A and one in which we forget to deduct D&A. On the left-hand side here, I'm going to work down, and so I'm going to start by assuming I have $10 of depreciation and amortization, which gets me to $100 of EBIT, or earnings before interest and tax. I'm going to tax adjust that by multiplying the 100 by 20% and making it negative because we have to flip the sign. And we end up with $80 of NOPAT. On the other side, we forget to deduct our D&A. So as a result, we have 110 of EBIT because we forgot to deduct it. We multiply by that same 20% and flip it to negative. So negative 20% of 110 is negative 22. And what we end up with is $88 of NOPAT. Stopping here, you look like you're better off in the right-hand scenario, the second scenario. But remember, depreciation and amortization is a non-cash charge that we need to add back. So I'm going to hop down below and grab a little helper here. Let's actually zoom out a little. Move this up and zoom back in. There we go. And we are going to now add back D&A. In the first scenario, we have no D&A to add back in the second scenario. So a little further there. And what we end up with is $90 of cash profit in scenario 1, but only $88 of cash profit in scenario 2. So in short, we are, relative to scenario 2, we're plus $2 in cash flow. The reason we're plus $2 in cash flow is we had a $10 deduction that's non-cash and a 20% tax rate. So in short, the $10 of D&A lowered our tax bill by the D&A times our tax rate. It basically just lowers taxable income. So to put that just kind of in a summary form here, we have $10 of D&A times whatever our tax rate is, in this case 20%, and that gives us a $2 savings. So this savings is the Depreciation Tax Shield. And what this basically characterizes is the tax savings as a result of having D&A. So that's the Depreciation Tax Shield. And in an interview, you'll be asked the question, what is the Depreciation Tax Shield? The short answer is it's the amount by which depreciation and amortization, or any non-cash charge really, lowers our taxable income and creates a cash savings. So that's the answer to the question. Hopefully this provides some clarity around the concept. Please do subscribe to our channel and stay tuned. We have a lot more questions coming soon. Hope to talk to you all shortly.